Hey everyone, today I'll be explaining the concept of current liabilities and taking up a question to further deepen your knowledge on this subject. Now, to start off, why is current liabilities important and how many types of liabilities are there? Current liabilities are especially important for the company to see how efficiently they're able to deal with short-term obligations. And now when we talk short-term obligations, we're talking especially within 1 year. Now, this is like the benchmark time frame when talking about current liabilities is within 1 year, within an operating cycle, within the fiscal period. Any of those terms, you can make out that we're talking about current liabilities. By using the calculation for current liabilities, we can also determine the current ratio, which is a very fundamental ratio used by the company and investors to see how the company is able to cope with their short-term obligations. Let me find right here. So yeah, here you go. Current ratio is basically found by dividing current assets with its current liabilities. Now that we have distinguished what a current liability is and why it's important, let's dive into the different types of current liabilities. So to start off, accounts payable. This is the most common one you will probably stumble upon, and is usually a less formal arrangement as compared to notes payable, which is considered a long-term liability that you will see later on. Accounts payable is a financial obligation to suppliers. Let me find here. To suppliers after purchasing products or services on credit that occurs within the company's operating cycle, as I was talking about before. This agreement is usually sent in a form of an invoice that contains purchase details, credit terms, invoice date, and shipping arrangements. So as you can see here, all the information is clearly labeled out. So the date, the invoice number, right? The items that we purchased from the supplier, who we purchased it from, the price. The invoice is like a short agreement that outlines all the details very nicely. Now, the next current liability we will be talking about is unearned revenue, also known as deferred revenue. And this is an advance payment a customer does for a product or service that is yet to be provided by the supplier. Now, unearned revenue right here is like advance payments. So some examples include, subscription services, gift cards, ticket sales. Like suppose you're buying tickets to go see a concert, right? So you will pay the $50 online first, and then you will go to the concert with the ticket. So you're just basically paying up front for the show, right? That's unearned revenue, basically. Next current liability we'll be talking about is taxes, right? Taxes payable. This is an interesting one because there's two main taxes that we'll be looking at. Sorry here. Sales tax and income tax. So sales tax results from the sales of products or services to customers, and this is usually in a form of a percent of the subtotal. So, that is very big. Make it smaller a bit. So this is an example of sales tax. You may have seen it everywhere. It's basically found on your receipts from any store. So right here, where I've circled below, the sales tax is a percent of the subtotal. Now this percent is variable to wherever you are. In this case, this receipt was taken in Flagstaff, Arizona. So whatever their percent may be for taxes, they take that, divide or multiply by the subtotal, and that's the taxes payable. Income taxes are required to be withheld from an employee's salary. So this is where it gets different. For payment to a federal, state, or local authority. This withholding is a percentage of the employee's gross pay. So same concept, except we're talking about someone's salary here. So before it was a percent of subtotal, now it's a percent of gross salary. Now that we've looked at all these examples of taxes and short-term liabilities, let's take a look at the question. So here, I'm going to move this over here. So some key words that we should look at whenever looking at some question like this. So we see that the company is making regular purchases of materials from the manufacturer. Spell that right. There you go. On credit. So there you go. And what this tells us is that, like I've mentioned before, we're talking about on credit here. Oh, sorry, on credit. So this means we're going to get the products first and then make an arrangement with them to pay off the debt later on. So that automatically eliminates this unearned revenue, right? It's not an advance payment that we're making the payment later on. So the next thing we will look at in this question, next keyword here, is that data is made within an operating cycle. Now this just ensures that it's a short-term debt. We already know that because all the options are short-term. Just for further knowledge, like when you see a question where you have to distinguish between current and long-term liabilities, if it says within an operating cycle right here, that is a good sign that we're talking about short-term here. The final giveaway we'll be looking at here is that the details of details are outlined within an invoice. And now invoice here is basically the giveaway because taxes payable don't really have an invoice, right? It's within the receipt or the receipt here, or within like your salary paid. But the invoice is mainly here to talk about, the accounts payable invoice. So yeah, so this is present within the accounts payable transaction. So we can easily circle B for that question. Hope I cleared up any doubts on current liabilities and added a bit more knowledge on how to break down questions within this topic. I'll see you all in the next one. Thanks.